Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are back with our resident coal expert, Matt Warder of Seawolf Research. Matt, thank you for coming back on the show.
Thanks, Steve. Love doing it and love talking to your crowd there. Yeah, it's been an interesting shoulder season. So I guess let's get into it and take a deep breath here and try to digest all the less good news than we had earlier in the
Okay, yeah. Well, let's start out with, like we always do, what is your macro view of the met coal market and the thermal coal market as we sit today?
year. Well, I mean, long term for both of them, nothing's particularly changed. We're still going to be short high quality production when we get out into the back half of the decade, whether we're talking on the met and thermal side. Thermal coal had a very surprisingly good summer. LNG prices had a surprisingly good summer, which allows coal some room to run. I didn't necessarily have that on my bingo card, but again, none of us are weathermen, so it's hard to predict those sorts of things. I think now the takeaway for thermal is that the range is pretty definitively bound, both on the bottom and on the top. And so, again, if you're marking to short term trends, then you want to let off the gas here and re-examine it when we get into fall, late fall, early winter, when prices tend to turn, and then pay attention to sort of import levels. For met, this shoulder season has been brutal. We certainly, I think when we talked in January, I mentioned that the prices for met coal had started to become long in the tooth, in the 300s, and that I was expecting a pullback into the 250s, down to maybe the mid to low 200s or something like that. And we've way overshot that delta, and most of that has been due to it hasn't really been the producers that are and the end users that are active in the market transacting these tons. The shoulder season is a quiet period for all markets, but instead we had traders get a bit off sides with regard to Indian elections in June, and then again with the Grosvenor fire in July, which, while I agree was a bullish event, it was a bullish event for the upcycle, which tends to happen in August, September, October, November, somewhere around in that area. Varies depending on year to year. So the fact that they got that a lot of parties got off sides with regard to their positioning has resulted in met coal prices falling down below 200, down to, it seems like we're stabilizing here around the $180 mark, which makes some sense. There's probably about 20 million, 30 million tons of production globally that's cash negative when you get down into the 170s there. So we should see some sort of rationalization here. I think most of the bleeding has stopped on the trader side. We'll have to continue to see. The difficulty has been that India, who was came into the market last year and put a floor under the price, at the level slightly higher than we were now, and then with just a little bit of supply tightness, the combination of India and China in the market buying took the price back up to 360, which is where we started talking back in January. So now, looking at it, I think the market is telling us that there's a short-term floor here as we move into post-monsoon season in India. We're going to see them come into the market and start to buy cargoes, and we'll actually get a chance to have real price discovery as opposed to people who are liquidating positions, selling, reselling cargoes, those sorts of things. That's really what's driven the spot price down to where it is. The other thing I think to point out before we move on to the next part of the question is that the spot market only accounts for about 2 to 3% of overall coal volumes. Yet it's the price that sets the index level by which people are settling contracts. So there's an incentive for end users and for traders to push the price down as much as possible, and to get tons as cheaply as they can for the next restocking season to start here in earnest. There are additional wrinkles with Chinese steel, but I think that's probably a separate question that we'll address here in a few.
Okay, so I'm going to share my screen here real quick, and this is thermal coal. So you think we've kind of found kind of range bound here with thermal, maybe the top around 150 or so, bottom around 120. Does that seem about right?
Ish. I mean, I would expand that because markets are going to be volatile. I'm not. I don't know anyone who's like particularly bullish on LNG prices over the
Okay.
next 5 years. So, I think in times of short supply, you could probably push up toward, I don't know, 160 or so,
Okay.
unless the supply shortage was particularly, short term. Or sorry, if the supply shortage was particularly acute, then you could push up into the 160s. And then on the downside, you can push down into 110, 105. I think adding another 15, 20% on either side just to account for short-term volatility is probably pretty reasonable.
Okay.
Um,
Okay.
uh,
And
you
then,
know,
oh, go ahead.
no, I was going to say long-term prices below 100 for like Newcastle spec, and I'm not sure that'll fly, but a lot of that depends on exchange rates and other factors as well as we get into long-term.
Okay. And then met coal here.
Well,
Um, we this is what you're talking about. It's recently sold off. We're sitting at 179 or so. You think we might be approaching a floor here around 180 or so?
yeah, I mean, you need to hit kind of a max pain point for anybody who hasn't liquidated a position yet. I think that's from a time standpoint, we're coming up on the time in the season where the Indian end users can't necessarily wait to buy post monsoon season cargoes. They're going to have to step in here because they'll need tons. Stockpiles were down, I think 4% a couple of weeks ago, and then 2% last week at ports. So they're drawing down stockpiles at this point. I think you'll see them come into the market over the next, call it 2 to 3 weeks. So if we have additional downside and somebody liquidates cargoes, you could maybe see, like a floor price. I would say is like maybe 160, but
Okay.
I think it's a short term floor, and we'll have like something really bad like China collapse or China announces that they're going to increase steel exports or just something that would really cause everybody to just get out. I think we're going to see some kind of stabilization here over the next 3 to 4 weeks.
Okay, but long term, we're still consuming more coal every year, and we'll consume more next year than we did this year. Long term, the thesis has never changed. This is just an extended shoulder season.
Yeah, or possibly very little to no shoulder season, depending on what happens with China. But the interesting thing about this part of the cycle is that it hasn't been a demand problem at all. This is probably going to be close to, if not the largest year for seaborne met coal for the seaborne met coal trade in terms of volumes. So, what we have is a problem with Chinese steel prices, and it's pretty specific. So on that in that part of the supply chain, that's where protectionism works. Protectionism works when the prices are low like this, and it allows, for instance, the U.S. to continue to be insular and not really import steel and affect prices. Where protectionism isn't so great is when prices are really high, and those taxes can get really onerous ultimately that affects consumer prices here. They're inflationary at high levels and protective at low levels. Still inflationary, but at that point when the world is bad, we need jobs to be stable. So different goals at different points in the economic cycle. India's demand for coking coal is not down, but the growth that they've been seeing in steel production has partly been coming from sponge iron production. So they're using natural gas to reduce iron ore as opposed to using coking coal to do it because it's pretty expensive, even still. And then shipping rates on top of that have been expensive. So the CFR, the minimum CFR that you can get delivered for is, Australia plus $20 a ton. So you're still in the twos to get it on shore, and that's you take about 60% of that, and that's your overarching steel cost. Um, I think for the top of the range here, short term, margins at Indian mills are somewhere in the 50 to 60 US dollar range. If you took about 60% of that, because that's how much is coking coal prices, it implies that we could see, a reasonable expectation for a top this cycle is like 210 to 225, somewhere in that range. And the only way that you're going to see a number above that this cycle, I think, is if we have, it's La Nina in the southern hemisphere, so weather problems in Australia, or cyclones, or there's production curtailments or cutbacks or those sorts of things. Those will have positive impact on prices. With a lagging delta of like 2 to 3 months, you'll start to see the effect of that. So again, I'm pretty constructive down here. I don't know if this is the cycle to back up the truck again like it was the last one. But there are starting to be short-term trades, I think, that could evolve if that's your if that's your preference. For me, I'm still accumulating for the longer term, so I'm just waiting to see when it's safe to get big.
Okay. Ben wants to know. He said you posted recently on Twitter that you recently caught up with Monish Pabrai.
Yeah, that's right. That's right. I did. That was a treat.
Yeah, what it said the best coal analyst and one of the biggest investors in coal coming together. Would love to hear any takeaways you had.
Yeah. So, I don't know how familiar anyone is with Monish's approach, but I can't necessarily sum it up in one word, but he's interested in companies that are going to compound over time and return that value to shareholders. And that's one of the reasons that drew him to AMR and to CEIX initially was because their buyback programs were incredibly strong. So now that Consol and Arch have turned the buyback off and AMR's turned the buyback off, your vision has to shift from being having a short term, capturing price beta on almost a leverage basis with these buybacks on to, all right, well, when do we want to make the next big bet, sort of looking forward. And one of the things that he talked about that I thought was, I mean, I knew to some degree, but I hadn't framed it in my own mind in that way, is that the U.S. companies relative to folks in Australia, there are assets that have these really long mine lives that span not just like 15, 20 years, but could span 50 or 70.
Wow.
And yeah, and so the value that comes in compounders is time. Time to withstand short-term cycles like this, and time to be able to absolutely make hay when price is in your favor. AMR did a great job of that on the way up and hoovered up 30% of their float, and now that's working against them to some degree on a price standpoint. But when you look out 5 to 10 years, for me, it's what's my valuation for them. It's about the same. It hasn't really changed, but that number is going to follow the beta of coal prices from now until doomsday, unless investors decide to make it otherwise. So for all these guys, when the buybacks turned off, the beta is going to get bigger. They're going to be more volatile, not less volatile. And obviously, when you're moving to the downside, that's not working in your favor. But the value, the long term, my long term price target for them at 13 million shares hasn't changed. Still 450, because that's what their DCF kind of looks like at a $250 coal price. But price for coal right now isn't 250, so your mileage may vary. When the market turns, they'll turn up again. So I'm comfortable accumulating pretty much any of those same Met names here, certainly here at these levels. But again, are you going to size it up and make it an outsized portion of your portfolio when met coal prices are making new lower lows? I don't think so. I don't think that's prudent. But there will come a time. I think on the short term perspective, that time may come soon where you could probably take a stand and take a 3 month, 4 month position. For me, I just rather buy a little bit at a time and continue to dollar cost average down or flat here as time goes on, and not necessarily be worried about what the short term brings, but rather be have the catcher's mitt ready for when the next upcycle starts, which could be next year. I mean, it could be, honestly, it could be 2026. All of that depends on China. That's a political event that I can't predict, and nobody else can either. We just have to sit back and react to it in real time. So, this year, sitting back and reacting to it has meant, wait until the market should normally turn up and then go, oh crap, it's not turning up. That's kind of what that strategy has done to me here this year. But, as Andy Edson from AMR has said in other calls, it's not fun, but it's familiar.
But so he liked the long term reserves that are present in the U.S. that may not be present outside.
Yeah, because that's what's going to make the difference, not across just this one cycle, but across many cycles. So if you kind of put that in the back of your mind and have that as a backdrop, a short-term fluctuation doesn't quite matter as much. And I know that's something that's always sort of present in my mind. But I'm thinking 5 years, 10 years down the road, and Monish is looking much further. And that's there. It was one sort of top level idea that sort of I was able to take away from that dinner. It's that sometimes my long term isn't long term enough when it comes to the investment side of things. And like it's hard to get rich from trading, but it is much easier to build generational wealth by accumulating and holding relatively good ideas. And the starting point matters. I don't mean to say that it doesn't, but the thesis matters, and just sometimes you have to revisit and see if anything's changed.
Yeah, he's thinking in decades. Um,
Yeah, yeah.
okay, let's move on to. Okay, so we got an election coming up, and I've been thinking about this a lot when it comes
Mhm.
to commodity investing. What do you see if Team Red wins, and what do you see with the Team Blue win?
Um, Globally, again, I don't think I would like to be so naive as to think that one person in charge of the United States is going to affect a long-term commodity cycle that's global. It can affect short-term geopolitical pressures, negatively or positively. Um, but I think, just speaking strictly for coal, um, I, if I'm going to speculate, I think one of the things that we have to do is, whether we like it or not. I mean, we'd love to reshore a lot of manufacturing, but if we do that, it's going to be incredibly expensive. It's either going to be incredibly expensive in the form of labor, or it's going to be incredibly expensive in the form of automation. And really, I think at this point in time, I was talking to my friend Mark Persano not long ago about this very topic. Whether we like it or not, China's the manufacturing center of the world because they have the expertise to do it. We don't educate trades anymore. There's a great comment out there from Tim Cook, or Tim Apple, as some might refer to him as, um, where he mentions, if you try to find tooling engineers in the United States, you could get like, you know, two or three or four, if you had a call for them. And if you do it in certain areas of China, you'll get two football fields of tooling engineers. And those are skill sets that we've lost over the years, or we've exported to China, because initially it was the labor cost that did it. But now the labor cost in China, at least according to Apple and others, have caught up. But the expertise elsewhere has really not. And that's why they've become, I think, sticky with regards to manufacturing. So if you think about it from a geopolitical perspective, we're, like it or not, we have a marriage, and it's a very messy one. We're the biggest area of downstream demand. They're the biggest upstream manufacturers. They need us, and like it or not, we probably need them if we want to really have prices under control. So, uh, and I'm a pretty firm believer in, I might be sort of left of center on social issues, but I'm a free marketeer, pretty through and through, because markets work. Rick Rule talks about that all the time. I know he's been on your show, and I think he said that even once. And the if we allow participation across the board, it's probably going to be beneficial. So when I think about the two candidates, regardless of my own personal ideologies or political affiliations, who's more likely to realize that need and make a deal with China? Is it the Democratic side, who has de facto adopted the same combative stance toward China that was developed under the Trump administration? But are they smart enough to know when to back off? Are they going to be able to successfully negotiate with China to do something? I don't know. And this comes from somebody on that side of the aisle. So I think if we do get a Trump presidency, I think there's a chance that we could see some sort of resolution to that. I don't know if that's going to resolve in additional downstream demand for steel, or anything that would directly affect coal markets. But it's certainly some sort of resolution there would certainly put global markets more at ease. And that sort of stability, I think, is what we're need and what we're kind of looking for. On the flip side, I think reasonable energy policy and reasonable regulatory policy with regard to the extractive industries is probably bad for pricing. It's probably bad for uh, underlying prices, because the more accommodative you are, the more you can produce. The more you can produce, the lower the price goes, assuming the demand doesn't necessarily change. So, in that sense, I think Democrats, which have been offsides with regard to energy policy for a long time, and have recently only come around with regard to nuclear and things like that, I think they're still kind of mired or doubling down on counteracting climate change or counteracting global warming or whatever you want to say that. And so I think some sort of I don't think those policies are going to get retrenched. I think they'll return. And as we've seen, when it's bad energy policy or misguided energy policy makes for dramatically better returns from those sectors than good energy policy or reasonable ones. So I think it's kind of a double-edged sword. You're going to win a little bit and lose a little bit, no matter who winds up in office. I know, just speaking from folks at the mines, when there's less of a regulatory problem, guys at the mines take a deep breath because they're less worried about, was the mine going to shut down because of some ideological goal that the infrastructure has. So, like, I think morale in the mining industry, I've heard anecdotally, would probably be better under Trump presidency. But me, I try to be balanced. It's kind of how, best as I can tell, how I think about it. But it's going to be a coin flip, and we're going to have good things to say and bad things to say, no matter which outcome it is. So just hope everybody can get past the election and be civil, and we can have a solid transfer of power and get back to business. I think it's the best thing for us.
Yeah. Okay. Ironically, Biden has been amazing for oil, as much as he hates it.
Hey, and the greatest oil trader that's ever lived, accidentally or otherwise. God bless it.
Yes. Okay. Jason wants to know about the met coal spot market. You touched on it, saying it's only what we're looking at on the screen is only 3% of the volume, right?
Yeah, I mean, physical markets are going to follow that spot market, but when there's no physical volume that's being conducted between traders and end users, then what is the price really when you go in to do term business? I think that's a question that really isn't being answered by the directionality on the spot price, and something I hope to have some resolution to here over the next 2 to 3 months. But mostly, that spot price is determined by any activity, whether that's physical, whether that's paper agreements, whether that is just the move from day to day of the bid and the ask. With, if you absent any other information, all of those publications, whether it's Argus or Platts, they're going to mark that market to whatever that delta is. I don't think that's the way to do it. I've been pretty vocal about if there's no transaction that's really taken place, on the physical side from producer to end user, then the price is whatever the last price was.
Yeah.
And that's what should be doing business on. I mean, obviously, if you're a steel end user, you disagree with me vehemently, but the number should be at least in the middle somewhere of where the spot transaction would be and where the last big physical cargo would be. Like, it's so disadvantageous to the coal industry to have this pricing regime. Like, I can't really begin to, it'll get me fired up if I talk about it too long. So I think something has to change at some point in time. I'd rather see us go back to a quarterly benchmark, if we're being honest, because I think when you do business on a more periodic basis, you actually have to look out to what do the next 12 months look like and get a deal done, as opposed to what does this look like right now and how can I take advantage of short-term volatility. For a bulky, slow lumbering commodity like steel and steel raw materials, the more time you have and the more you can average that out, the better it looks for everyone, steel producers included, because you can make plans. Whereas we don't always know how the whims of the spot market are going to act, especially if the biggest actors are financial institutions and commodity traders.
Yeah. Okay. AB, Conrad, and a whole bunch of other people are asking about AMR. He says, is
Yep.
AMR still exciting to Matt, given they've stopped buybacks and dividends to firm up the balance sheet? What's your strategy now on AMR?
I mean, I said it before, like for me, like the whole idea about my own personal risk management during shoulder season is, well, you need to take down exposure before prices start to run down. Ideally you do that, kind of for met coal, you do it in January, February, and then you begin to think about sizing up when you get to July, August, September. But like all the price action, with the exception of the Grosvenor fire, has been negative in July, August, September. And I haven't had all that much time to write about it. And what I do write is still kind of very long term oriented. So the value proposition for AMR really hasn't changed for me over the long time. It's just when are you going to get big next? From a cost perspective, I expect them to manage pretty well. Even down here at 180, I mean, it might not be a pretty quarter, but they're going to make money. They're going to do what they need to do in order to manage costs. They're going to do what they need to do in order to manage production. I think they're priced and committed for the year. And then, there was a comment, I think Andy made it to me, it might have been Dan, but the difficulty with spot markets is, well, you got to sell coal 12 months out of the year. The price might only move, 2 or 3 of them, but it is what it is from a long-term perspective. And, they know that, and they were, I think if you go back and look through quarterly earnings calls last year, they were pretty well prepared for it last year, but it wound up hitting this year. So yeah, I'm still excited about what the long term shows for them. And I think when prices get down to a level where you can definitely see a met market turn, I think you'll probably start to see some activity, not just from the folks in the company, but from other firms as well. Where's that line in the sand? I don't know. Is that 150 or 160 or 180 or to me, it's all arbitrary down here. Below, I mean, I think the level that I was looking at was like 265, where this is probably too low for what I think the future is. So it's all sort of gravy down here. You just can't go fast, and you can't get out over your skis on anything. This is you were in accumulation phase, and it means dollar cost averaging down very, very slowly. That's me. That's not how I'd run a book if I were managing a hedge fund or stuff like that, probably. Those guys may, when you have these turns, maybe you want to pick your longs and then be short the curve, or be short producers you don't like, or put on hedges that sort of work like that. There's lots of ways to do it. But for me, it's kind of, I mean, I'm long only in my 401k. I don't really have a choice. It's just you have to manage the cycles, and this one's just longer than the last one.
Okay. And Zishan and Jason want to know about the Alabama Coal Company Warrior Met Coal. Any updates on Blue Creek, on Warrior Met in general?
I mean, they're dealing like everybody else, kind of managing the downturn. One thing that I have sort of done some work on here recently is that we've always thought about transport costs in the U.S. being more fixed than they actually have become in practicum. I think we're going to see, even as prices come down, I think you'll see margins kind of flatten out, unless prices really, really move, really tick down to the downside. And that's an okay situation to be in. If the rails are incentivized to continue moving tons, they don't want to have negative connotations to their crews. They want to maintain their crews. They want to move as much coal as they can. That's how they make money. And when the price goes way up, those rates are going to go way up. They're going to make a lot of money. But down here, even if rail rates go down by 40-50% relative to where they were before, they're still doing fine, and it also keeps the coal relatively competitive into the seaborne market. So there's and everybody in the domestic side understands this. The steel mills understand how much they need how much they need to pay to get the coals that they need for their own stability, and the rails know how much they can charge to keep U.S. coals competitive. Now, the same isn't necessarily true in Australia, where you have a lot of take or pay contracts on rail. Those prices tend to be more fixed, whereas in the U.S. they're variable, and I guess from recent conversations I've had, maybe a little bit more variable than even I thought they were in the past, which in turn means that the cost curve is even more volatile. It's not just the royalties that push it way up at these really high prices, but when those royalties come off, you also have at least in the U.S. some rail prices, rail costs come off as well, and that makes for a really difficult universe to forecast. Because if you don't get the initial price right, you get the royalties and the rail rates wrong. And then if you adjust the rail rates and the royalties, and at those new prices, you're going to get a lower forecast, and it's going to be a self-fulfilling prophecy when you keep those things going. So you have to really look at more at supply demand balance, and there's still not a whole lot of tons that are coming on, especially for higher quality coal. So that's kind of how I have to set my compass. Deal with the short-term volatility, understand that numbers can go up and down, and they might not mean anything until you have volume, and then just wait and watch to see what the next cycle is going to be.
Okay. Lazar, Gabriel, Conrad, and Jason are curious about the new coal company coming out, Core Natural Resources. I saw it's going to open up in Q1 of 2025. They're talking about the Consol and Arch merger. You touched on this before. What's the revenue mix going to look like between thermal and met with the new company? And what's your opinion on the merged company?
That's a good question. Easier for me, I think, probably to just pull up the the models that I have on them. So from my perspective, it does a couple of things. Arch's value proposition has, for the last few years, has always been Lear and Lear South. They've had a little bit of trouble producing there. Those seams are pretty gassy. I've heard anecdotally. Mining conditions aren't always the best, but when they work really well. One of the struggles that Arch has had, through no fault of their own, we had the blow up at Curtis Bay a while back, and they had to reroute tons, and then he had the bridge disaster, and they had to reroute tons from Northern App to Central App. And then anyway, they've had a lot of bad luck with regard to shipping those Northern App tons. One of the reasons they had trouble was because they, were stuck with port access at Curtis Bay, which is served by CSX. CSX owns that port. Consol brings to the table another port, and Consol owns it completely. So the combination of those assets and additional throughput through Northern App, I think, is really where the best synergy lies. So on the thermal coal side, Consol's producing, let's call it 25 million tons. Let's call it 20 because some of that gets sold as met. So it's 20 million tons times, we'll call it 120. So it's like, 2.4 billion in revenue ish, if we just use the export price, right? And then Arch is going to produce, call it 7 times,
170 or something.
Yeah, let's call it 170 met. So that's another, 1.2 billion.
Okay.
So the tons went out. The tons of Consol are probably going to win out on the overall revenue side. And we got to keep in mind Arch has the PRB, which is going to be a lot of, pretty good fair chunk of revenue, but razor thin margin. So it factors into the overall earnings a little bit different.
Okay, so about a third met and 2/3 thermal, something like that.
I think it's going to be more, closer to 60-40 thermal met.
Okay.
55-45, without actually breaking out and doing the math myself here on a pro forma basis. The other thing I think that will help is Arch's Central App mines give Consol's Itman operation, CSX, access as well. And Arch owns some throughput at the CSX served DTA port in Newport News. So it's a bit of a haul from Itman up to Beckley. It's not incredibly far, and it's probably not going to happen at these low prices, but it gives the combined company some shipping flexibility that it didn't have really before. So if they do something like let's say either sell down the PRB, or alternately find like maybe a CCUS project like has been proposed for Peabody to do, that the PRB becomes like a call option, either to get some value monetized with a special project, or alternately to sell it off altogether. And I think everything else kind of stays, and other than the transportation synergy up north, I don't know if the other ones, really move the needle on, on the combined value. But it certainly will, take the peaks and valleys, I think, out of Arch's, production performances that we've seen in the past. Consol has the best longwall operating culture in the world. And when you think about transferring, that knowledge and best practice and expertise to, the Lear assets in West Virginia, to me that seems the biggest yet. Plus the transport out of all of it. So I like it. I need to do the work on a pro forma basis to see what the revenue and margins are going to look like, especially considering we'll have probably resilient thermal and a met market that is a bit in limbo over the next few months. May not be great for that, but I think by the time the deal goes through and the buyback is operational again in Q1, we're going to have two monster quarters from Consol to absorb, and that'll be ready to go on the balance sheet. So this is one I'm looking at more for 2025 right now, because I think once they put the buyback under that, it's going to perform really well. But we'll see. It's like 6 months from now, the prices can go any direction. So deep breath.
All righty. Leo is asking about SunCoke. What are your
Okay.
thoughts on SunCoke?
So SunCoke, to me, the long-term value of SunCoke was almost directly connected to this Nippon Steel U.S. Steel merger, right? Part of the get with, and I still can't believe that both political parties are against this deal. Financially well-positioned company with a huge balance sheet from an ally, with the possibility to offset some Japanese production and move it over into this hemisphere, specifically into America, where we'd increase steel production, which would increase jobs, and it would offset scope 2 and scope 3 emissions for them, because it's easier to ship it from here to places where it's closer than otherwise. Like, it makes so much sense to do, and yet both of these hoodle heads are against it for whatever reason. Whether that's we're playing for union votes in Pennsylvania, which probably what it is, let's be frank, or some other more nefarious reason. It didn't make a whole lot of sense to me to be so committal on it, really, on either side. It had been posited by a number of people on Twitter that, including myself, I agree with the thesis that it was probably a deal that would go through in a lame duck session. And now looks like we're going to put the kibosh on it before it happens. But SunCoke has a production facility that is over at near U.S. Steel's Granite City operations, which are currently shuttered. And they have another coke plant down in Jewell. Well, had Nippon Steel actually taken over, they'd promised to invest $1.2 billion in the Mon Valley Works in Pittsburgh, which would have kept that blast furnace going for another 10, 20 years. And also in Gary, where they'd been shutting down blast furnaces for a while. So in my mind, that would have necessitated an increase in coke production domestically, which we sell domestic tons when prices are low like this globally at a better price than we do globally, than we do in the seaborne market. That would have provided some great insulation for U.S. domestic U.S. met coal companies in particular, and I think would have turned SunCoke into like an outperform. And man, absent that deal, it's hard to get super excited about the prospects of domestic production, because they were on the decline for a number of years and are projected to still do so absent somebody coming in. So the loss of that merger really hurt the prospects for domestic coke producers. And out of all the things that have happened during this election season, that's the thing that's pissed me off the most. Is it just you don't have any candidates that are serious about understanding what the second and third order effects are of allowing commerce to take place like this. It's a real shame that it went the way of that. I hope they revisit it, but we'll see.
Yeah, I was talking with my buddy about this, and we're in the same boat. How do you see like Cleveland Cliffs maybe being the one that could benefit, or is this just kind of a nix across the board, do you think?
I don't think Cleveland Cliffs has the balance sheet to absorb that. At least I'd be surprised if they did.
Okay.
My suspicion is Cleveland Cliffs has a lot of legacy liabilities with regard to the union. And so, they have an incentive probably to get bigger so that they can paper over that difficulty. And I forget what year, that becomes an issue. I haven't done the work on Cliffs in a while because, again, that's another beta play. When steel prices go up, Cliffs does amazingly. When steel prices go down, not so much. But would they be interested in buying, part of the operations? Yeah, maybe probably see something like that. But the whole thing after they bought Stelco, I don't know how many more bullets they have in that gun. And then worse, if you're going to say, well, the Japanese can't come and invest in the United States, I think that rules out Mittal as well.
Yeah.
So I don't know if we'll let the Indian steelmakers come and invest in it. So I don't know where this is going to go. Like I said, I'm pretty pissed about it. But U.S. Steel's a really good value down here just because they're going to increase production of Big River Steel. They're going to get the benefits of some of the Inflation Reduction Act for going more green friendly on that. So there's a silver lining, but I'm still upset over that
Okay. Well, sorry to scratch that wound.
one. Sorry.
All right. Jeff wants to know, what does Matt think about the Anglo assets for sale?
I mean, it's good coal. The question is, what price is it going to have? I would assume, and this is just me talking. I haven't done any work on it, but the Grosvenor fire seemed to indicate to me that that asset might be a zero at this point in time. I don't know. I have no information on how much damage was done to the underground equipment. Um, no idea what would take to bring it back online. They've been pretty hush about it, and I assume they're letting whoever's going to court them go over. But the bottom line is they're not making any more of that type of coal, and somebody's going to have to shepherd those assets through the rest of their mine life. Who's best positioned to do that? I don't know. We'll see. I prefer to see somebody like Glencore go get it. But we'll just have to kind of wait and see how how everything shakes out to have a real opinion of it here.
Okay. Thermal coal question. ASD and FT want to know about Yancoal. They recently cut their dividend program. How are you
Yeah.
feeling about Yancoal?
Well, I mean, so the dividend is their value proposition, right? So they're not giving back money. It's hard to get, and again, this is short term. This isn't long term. Long term, they're fine. The thermal coal market that they produce is going to be fine. Their costs are really good. So let's not confuse, short term market dynamics and political decisions with, the long term value. Long term value is still there. But if they're going to make a run for the Anglo assets, well, I guess it is what it is. They're not going to return value. It's hard for people who are owning them for that reason to continue to hold it. So that's the reason why it's come down here. Is it a buy? I think in a vacuum and your only view is long term, yes, of course. But if you're price sensitive in the short term, you have to take a beat and see how it winds up equilibrating. I mean, if they wind up making a deal for those, for those assets, then that's a lot of money off the balance sheet. There's going to be financing. I don't know if that resolves in debt. There are a lot of ways that could go down. Would they be, a more interesting, diverse company if they had them? Yeah, maybe you can make the case for that. But for me, they were my preferred, kind of Australian thermal coal play because of those shareholder returns. If the shareholder returns aren't there, you just have to, well, you got to take a beat and see how this pans out.
Okay. And we got a few questions here on the coal ETF. So you had a hand in advising and kind of putting this thing together. Diogenes, Anil, and Ollie, what's your current view of the coal ETF?
Well, I mean, it's going to perform the way coal prices are, right? The whole idea is to capture kind of the average beta between met and thermal, and the holdings were sort of designed to do that. So it just happens to have launched right before a massive peak and then this big drawdown. But I haven't looked at it in a while. Let me see if I can pull it up on TradingView.
I could pull it up. I got it here.
Sure, yeah, go ahead.
Okay. It is right. Yeah. There we go. Yeah, so I just checked, the assets under management are now 9.3 million with 470,000 shares, is kind of where we stand today. What do you see with that, as far as, you know, how much assets under management do we really need to where, like, maybe I don't know, like a hedge fund or something become interested?
I mean, what they can do right now is, people who are under compliance regimes who want exposure to, to the broader coal markets, they can buy this and just hold it. Obviously, it's going to behave seasonally because the equities behave seasonally underneath them.
Yeah.
But as far as total assets under management, these are the same guys who built I can't, one of the two uranium ETFs. I can't remember
Oh,
which set.
URNM or URA?
Yeah, they were the second one. They were second one to market, the one that has a better construction.
Oh,
Uh,
URNM.
so, and I think it took about a year or more to get, TAM up to a level that they could provide some liquidity. So, you know, this is it's a work in progress. Last time I looked at the total value, it was like a couple million.
Okay.
So
All right.
it's moving in the right direction in terms of participation. But obviously, from a pricing perspective, if coal prices are going to go down, then so's the coal ETF.
Yeah.
Just looking at it here, it's supposed to be 50-50 met thermal, and like, I'd have to go through and look at the holdings, but I would expect to see more of if we had a 50% drawdown and thermal coal didn't, it went up, I would expect to see like that turn into like more 25. But what was it there, peak to trough?
Oh, from up here,
650.
26 to up at the peak down to 20, we'll call it. So is that 25% from the peak?
Yeah, something like that.
Not too bad.
6. Yeah, so and that's since July, that was like July 1 when the met coal assets ran back up. I'm just looking
Yeah,
there.
yeah, beginning of July.
Okay, so that's the Grosvenor fire. So they got a 10% boost from the Grosvenor fire and then corrected by 20.
Okay.
Uh,
Okay.
so that kind of is as expected. Like I said, I have to go through the holdings to get a real definitive opinion of it, but um, you know, we're moving into a period where thermal coal prices should fall and coking coal prices should hold or rise. So I would expect that number to kind of be flat to down until you get to winter, and then in winter time I would expect that to move up.
Okay. All righty. And Lazar and FT want to know, what do you think about Whitehaven?
Uh, so the Blackwater costs I think looked pretty high. They didn't report exactly, I don't think. So higher costs are a little bit of a concern. The relativities with regard to the non PLV portion of those assets, anything that isn't second tier hard coking coal or above, is probably going to be negatively affected. If we get down to 160 or whatever, I'm not sure if they'd be making that much money. But I think there have been a couple of comments that the type of management that they'll employ going forward makes it easier to make adjustments. We'll have to see if that pans out. But in general, the diversification for Whitehaven from a thermal coal to a met coal producer is going to play out in the long term. Not in the short term when coking coal prices have come under not just seasonal pressure but also cyclical pressure from China. But I do think this is one where if we look back in 3 to 5 years, quibbling about the short term on this one's going to look pretty silly. So,
Okay.
I get, whenever the market falls like it does, it creates, anxiety about, what should I do with this position or that position. For me, especially after the first 2 years of this coal move, I'm me personally, I have to be more agnostic about pullback because we expect them to come, even if we don't expect them to be this bad. But if the thesis hasn't changed, then it's an opportunity, not a cost. But I think I said this maybe last time, but if you're allocating capital at scale, there are better places to look than coal at the moment, and you can't deny that. That's okay to say. It's not a real big deal. But long-term, Whitehaven is going to be fine, yeah, for
Okay.
better or for worse. Yeah.
Okay. And Jason wants to know about Peabody, BTU.
Mhm. Yeah, Peabody's had a pretty interesting few weeks with the activists filing for Thomist Capital, and they also had an earnings report in there which was markedly more upbeat and shareholder friendly than we've seen in the past. Don't think that's an accident. I think that's to be expected going forward. Thomas brought up a few things that where Peabody could create value, and they can talk about it as potential strategy, and they can evaluate it going forward. One of them was to sell down part of Centurion, a la Whitehaven did with Blackwater, right?
Mm-hmm.
You can do that. That's perfectly fine. That's probably the easiest way to get to a short-term gain, improve the balance sheet, maybe improve buyback or something like that. I mean, it's pretty easy. I'm sure you could find a partner for it too. Whether that's the best approach or not, it's fine. Me thinking about it just from a strategic standpoint is now when you want to go to market to try to find value for that. I think the Japanese mills or the Indians would see value in that. I don't think they're going to see 180 and go, oh, that's the long-term price. No, I think the long-term price is still 225, 250, somewhere in that range. And you'll see a deal get done on some PLV equivalent like that. But do they want to pay it at this point in time? I don't know. That's what I couldn't tell you one way or the other. The other thing they talked about, which personally I think is very interesting. It's a very difficult strategy to go and execute. Is the possibility to build basically a mine mouth power plant in the PRB to service the growing demand for AI data centers. So when people have looked at, including Peabody looked at this, I think, in 2019 or 2020, I can't remember. When people have looked at doing a power plant in the past for carbon capture and sequestration, which is really what the get would be here, right? To utilize the Inflation Reduction Act credits for capture and storage to force multiply the value that you can get out of the PRB, turns PRB into a call option, which is pretty good idea. That proposal has been done in the past. A few things they haven't talked about. One of which is, as soon as logistics enter into that discussion, the railroads are going to take a pound of flesh. So you can't locate that plant immensely far away from where production is. The longer the haul, the more the railroads are going to take, and your economics are just going to get absolutely discombobulated.
Yeah, they're going to get washed out.
Right. If you do everything locally, and Wyoming has plenty of space, it has plenty of water, plenty of. It's not like the first time they built a power plant, for instance, but they're and they already have. I think it's Amazon that's building facilities out there, or Microsoft, one of the two. I was at the West Virginia Coal Association's meeting. This was like the first week of August, and I spoke at some length with Travis Detai, who's the chairman of the Wyoming Coal Association, and they've been trying to get this to happen for a long time, but there's some optimism that they can actually get some traction here, and if they do, then that becomes a game changer. I just think it's a lot of cats to herd because you have to get the politicians together, and you have to be able to pitch it to folks like Senator Manchin, maybe the Colorado senators Hickenlooper and Bennett, who were partially instrumental in bringing Manchin back to the table for the Inflation Reduction Act. Like those three people, I think would be amenable to it. Certainly, John Barrasso in Wyoming say yes. Certainly, Wyoming politicians would say yes. And then we have the end of Chevron deference, which although I understand doesn't necessarily bode well for Clean Water Act applications that goes back to the feds. But for most every other application, you can probably clear some red tape for it. So the infrastructure's there, the credits are there. What you don't have is organizing Baker Hughes for their turbines, or organizing Occidental for their storage, or organizing the political class, or organizing either Microsoft or Meta and then organizing BTU. And that's a lot of moving parts to get together to do one thing. I think it's worth it to do, because if we prove carbon capture and sequestration at scale, at a 300 megawatt plant, 400 megawatt plant level, that gives us the ability to say, well, if we can do this here, we can do this in other places. And it's always been my view that if we are going to solve carbon, we need to take a multi-pronged approach, not just one. And this would be a way that we can not only continue to use coal and fossil fuels domestically, but also we can start to export that technologies to other places. Wherever there is oil and gas production, you have storage. So, if you think about, Western Africa, all the oil production that's there, all of a sudden, coal-fired production makes a lot more sense if you have somewhere to put it, if you have somewhere to put the carbon. So I don't, this is definitely not going to immediately help BTU, but I do think it's an important story to talk about and to have a think on a bipartisan basis, at least to shepherd this 3% per annum growth that we're going to see in power demand. So I'm going to step down off the soapbox as a long answer, but I hope that makes sense.
Yeah, it does. Basically, that could open the door for other smallish power plants like this that could power data centers or
Yeah,
cryptocurrency.
and we need it. I mean, if I don't know if artificial intelligence is going to be the savior with a lot of the problems that we have, but there is some there is some merit to the argument that, well, maybe we should build the power capacity, and because whoever builds it first, it's a race notice to get to the point to be the dominant AI player on the world.
Exactly.
And the country who gets there first is going to win a lot of geopolitical battles with regard to that.
Oh yeah.
It would behoove us not to be first in this, because if we don't, China's going to do it.
Yep.
And that's a one geopolitical opinion I think I have is pretty strong. If it's us, there's promise in dispersing that to a lot of places and solving a lot of really critical problems. If it's someone else, we don't necessarily control their priorities. So there's that.
Yep. I've also noticed, this is just side note, but BTU has been one of my favorite ones to play options on. It's a Charlie Brown pattern, it's like, it's so
It's
much
liquid.
fun.
Yeah, I haven't pulled it up here, but like, just looking back a year, I mean, one of our friends on Twitter calls it the BTU secret money hack.
Oh man, yeah, here, I'll do it right now. It's just there you go. There's the Charlie Brown pattern, I mean, if just the kindergarten method of buying it when it's $21 and selling it when it's 24 seems to have a pretty good time,
Sure, and obviously at the bottoms keep your stops really tight. But like, how I look at that is I'll put one of the band systems like Bollinger Bands or Keltner channels or something like that. I
Mhm.
want to see a 2 standard deviation move up,
Okay.
and then relative strength index is a big dumb indicator, but it's usually not too bad.
Yeah.
To see overall oversold, overbought volumes. So a relative strength index in the 20s or 30s, plus going far below the 2 standard deviation move on like a Bollinger Band. It's a good time to buy some calls or take a flyer on that.
Yeah.
You have to pay attention to news, but I mean, uh, you know, 60% of the time it works every time. Uh,
Alrighty, I know you got to get going. Last question here from
yeah.
Conrad and Liberty. What do you think of Glencore? Do you believe Glencore will spin off coal assets or hold on to them long term?
I mean, it sounds like they're going to hold on to them long term. I think that's really a shareholder question. And they said they were going to spin it off. Now they say they're not. I'm going to take them at their word and assume that they're not for the time being. I'd also wouldn't mind seeing them put in a bid for some of these other assets as well, because they're going to be, I think, the best shepherds for them over the longer period of time. They certainly have the commodity trading expertise to force multiply that, but exactly how it's going to fare in the short term, hard to say. Um, Glencore, from an investment perspective, obviously I love in the longer term, but in the short term, it's very heavily predicated upon, well, what did copper prices and coking coal prices do? And at least lately, that hasn't been it hasn't been very fun to watch.
Yeah, we'll see how it performs during the recession, but yeah, I think Glencore will do amazing over a 5-year period.
Yeah, I think so too. The tech assets, especially once they get paid for, and then that just becomes a free cash flow, you know, cash cow for them is just pretty spectacular. And like even tech makes money at 180, tech makes money at 200. They'll make money at 160 over there. So like those assets are world class, they're top notch, they're top quality, and at these price levels, that's one of the few places that China can go to get strength contributing properties in coal. So it's a no brainer for a lot of participants.
Yeah, how much longer before they're done paying the debt on tech?
Oh, I can't remember if it was 28 or and it might even be a little bit longer. Um, I don't know. I need to open it up.
Okay, no,
I
fair
had
enough.
always assumed like three and a half years.
Okay.
So like toward the end of the decade. But I never did really hard and fast math on that because Glencore is just one of those companies that, when I put money in the IRA, I always buy a little bit of. So,
Yeah.
kind of price agnostic to that.
Okay. Awesome. Well, thank you very much, Matt. Do you have any closing thoughts? Anything you want to wrap up on?
No, not really. I think we're at this. We're at an inflection point. I think in met coal markets, we're heading into shoulder season for thermal. We need to see the narrative help. Hey, we need some narrative help. I think from the broader market. But in my experience, whenever I get really excited, is usually a good time to sell. And whenever bears get really excited about, whenever any of us are out there doing victory laps, it's always probably a good idea to at least think about doing the opposite at that point in time. Because it's tough for me because I love this industry. It's a big part of the culture where I grow up, and like, I don't want to root publicly for like a company to do poorly. That's why I tend to talk more about price than about buys and sells and those sorts of things. And the truth is that the price is going to be volatile, but the long term thesis is intact for both met and for thermal. And when that changes, then we'll have a big serious conversation. But for now, I think we just kind of have to wait and watch what China does. We'll have to wait and watch the outcome of this election and kind of put those two ideas together and see if the near term changes materially for the steel and steel raw material space. I think it probably will. If the Democrats win, I think we probably just takes about 12 more months, but China will work through that steel glut. And then, again, I think, if the Republicans win, we're more likely to see some kind of a deal get done on the trade side because, nobody wants, all these global industries to do poorly. We want them all to do well, and a rising tide lifts all boats.
Okay. Right on, Matt. I will put links to your contact down below if people want to contact you for Seawolf research. Thank you again for coming on the show.
It's my pleasure anytime. Looking forward to next time.
I am as well, sir. And thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.